Okay, everyone, welcome back. Today's Monday, or November, man, already in November. November 4th, 2019. Today we're moving on to Chapter 13, dealing with partnerships, characteristics, formation, and accounting for activities. I just want to apologize to everyone for not getting the exam scores posted yet. I actually have not had a chance to grade them. I will have them posted no later than tomorrow for sure. I will send everyone an email out as soon as the grades are posted. My hopes is that to have it posted before noon tomorrow. And as I said, I will notify everyone once the grades are up for exam two. Um, Homework for chapter 13 is already posted down here in Moodle. So for chapter 13 homework, we're going to complete from the end of chapter 13, complete understanding the issues 1 and 3 and exercise 3. Now this homework will be due next Monday at 11:55 p.m. and once again later in the week or by class next Monday. I will go ahead and post the solutions to chapter 13 homework so everyone can get their credit that due for that assignment. But as always, please attempt these questions on your own throughout the week for practice and use the solutions as a checking point, as a reference for the work that you've tried. So that's that with homework and that of the exams. Exam scores for exam two. Like I said, I'll be posting those no later than tomorrow. So let's go ahead and get into chapter 13. So partnerships, characteristics, formation, and accounting for activities. So what are some of the learning objectives of this chapter? We're going to explain the basic characteristics of a partnership, identify basic components that should be included in a partnership agreement, describe the relationship between a partner's drawing and capital accounts, and then we're going to demonstrate an understanding of the various bases that could be used to allocate profits or losses among partners. Okay, so a partnership is an association of two or more people for the purpose of carrying on a trade or business as co-owners. Some common examples of partnerships include professional services, such as the practice of accounting or law, real estate investment development companies, and a variety of smaller manufacturing concerns. Partnerships may be organized as either a general partnership or a limited partnership. In a majority of states, the legal nature and functioning of a partnership is governed by the Uniform Partnership Act of 1997. And this act has been revised and amended since then. Now, the Uniform Partnership Act of 1997 is going to be referred to as RUPA, R-U-P-A, as in the revised UPA, which is the revised Uniform Partnership Act of 1997. And it's going to deal with such topics such as the rights of partners, relations with persons dealing with the partnership, and the dissolution and termination of a partnership. So, characteristics of a partnership. Practicing accountants are frequently asked to advise clients regarding the formation of a business and the accounting for the business activities. Now, oftentimes a choice must be made between a partnership and a corporate form of organization. So, knowing this, it is important for accounting students to understand the basic characteristics of a partnership and the related accounting implications. So, what are the relationship of partners? A partnership represents a voluntary association of individuals carrying out a business purpose. In this association, a fiduciary relationship exists among the partners, requiring them to exercise good faith, loyalty to the partnership, and sound business judgment in conducting the partnership's business. An individual partner is going to be viewed as a co-owner of a partnership property, creating a tendency in partnership. Now, the relationship between partners is also characterized as one of mutual agency, which means that each partner is an agent for the other partners and the partnership when transacting partnership business. Therefore, in carrying on the business of the partnership, the acts of every partner bind the partnership itself, even when a partner commits a wrongful act or a breach of trust. So, legal liability of partnership. Partnerships are classified as either general or limited regarding liability of the partners. In a general partnership, the partners act publicly on behalf of the partnership and are personally liable, jointly and severally, for the unsatisfied obligations of the partnership. Thus, if a partnership were insolvent, the unsatisfied creditors could seek to recover against the net personal assets of individual partners. Now, in contrast, a limited partnership consists of one or more general partners and one or more limited partners who contribute capital but do not participate in the management of the company. The one or more general partners have unlimited liability, as is the case of a general partnership. Now, however, the limited partners' liability for partnership obligations is going to be restricted to a stated amount, usually equal to their capital interest in the partnership. The legal liability of partners is obviously a serious factor to consider when assessing whether a partnership is the appropriate form of organization. Now, virtually every product or service industry, from cigarette manufacturers to the medical profession, has been affected by liability issues. And now, in response to this growing concern, two new forms of organizations have been created. These two new forms consist of a limited liability company, known as an LLC, and a limited liability partnership, known as an LLP. The first one, the LLC, is a hybrid form of organization that has many of the advantages of both a partnership and a corporation, but few of the disadvantages of either. Similar to a corporation, shareholders of an LLC do not have personal legal liability for actions that are undertaken by the entity. An LLP is a subcategory of general partnerships. The LLP compares favorably to limited or general partnerships with respect to liability. All partners in an LLP may participate in management, unlike that of limited partners, and still have limited liability. Now, partners in an LLP are not personally, jointly, and/or severally liable for obligations of the partnership that arise from the omissions, negligence, wrongful acts, misconduct, or malpractice of other partners. Continuing on with the characteristics of a partnership, some of the underlying equity theories. So equity theories relate to how an entity is viewed from an accounting and legal viewpoint. So pretty much the question is who is the entity? For example, an entity may be viewed as being providers of capital, individual owners in the form of partners or shareholders, management, or a separate, distinct legal entity. Partnerships have been primarily affected by the proprietary theory, which looks at the entity through the eyes of the owners. Characteristics of a partnership that emphasize that the entity is viewed as the individual owners include the following. Salaries to the partners are viewed as a distribution of income rather than a component of income. Unlimited liability of general partners extends beyond the entity to the individual partners. Income of the partnership is not taxed at the partnership level, but instead is included as a part of the partner's individual taxable income. And lastly, an original partnership is dissolved upon the admission or withdrawal of a partner. Now, partnerships also have been influenced by the entity theory. This theory views the business unit as a separate and distinct entity possessing its own existence apart from the individual partners. This theory is characteristic of corporations, yet it is the basis for certain partnership characteristics as well. For example, a partnership may enter into contracts in its own name. Also, property contributed to a partnership by individual partners becomes the property of the partnership, and the contributing partner no longer retains a claim to the specific assets that has been contributed. So some of the formations and agreements. A partnership may come into existence without having to receive formal, legal, or state approval, and may result simply from the actions of the parties involved. Now, in order to properly capture the intent of the partners involved, it is advisable to develop a written partnership agreement. Now, some of the critical issues that must be addressed include admission of the partners, withdrawal of partners, and the application of profits and losses, or the allocation of profits and losses. Such an agreement is referred to as the Articles of Partnership, and at a minimum should include the following provisions: the partnership name and address, partners' names and addresses, effective date of partnership, a description of the general business purpose and the limited duration of such purpose, if applicable, powers and duties of partners, procedures governing the valuation of assets invested, procedures governing the admission of a new partner or partners, procedures governing the distribution of profits and losses, procedures governing the payment of receipt of interest on loans among the partners, salaries to be accrued to partners, withdrawals of capital to be allowed each partner, and the determination of what constitutes excess withdrawals, procedures governing the voluntary withdrawal, disability, death, or divorce of a partner, and the determination of the procedures for valuing the partner's interest in the partnership, matters requiring the consent of all partners, the date when the profits and losses are divided and the partnership books are closed, the basis of accounting, whether it's going to be an accrual basis or in a cash basis or a modified accrual or some type of other comprehensive basis of accounting, which we will be getting into later in this lecture. So once again, these are just what some of the provisions that should be included in the Articles of Incorporation at a minimum. Now, even though the RUPA, which is the Revised Uniform Partnership Agreement, the Revised Uniform Partnership Act. So even though the RUPA covers certain topics found in the Articles of Partnership, it is important to note that many sections of the RUPA are applicable only in the absence of a partnership agreement. In essence, the RUPA gives supremacy to the partnership agreement and is a series of default rules. So in essence, pretty much RUPA is going to be default rules in those instances where the partnership agreement fails to clearly address a particular matter. Now, legal and accounting issues affecting a partnership are often best resolved by evaluating the intent of the partners as set forth in a partnership agreement rather than looking to the RUPA, because recall that the RUPA is just a default set of rules as if the partnership agreement was not intact. So now, what are some of the acceptable accounting principles? There is a general presumption that an entity's financial position and results of operations should be accounted for in conformity with generally accepted accounting principles, otherwise known as GAAP. As GAAP has developed and become more complex, many have questioned the applicability of such principles to smaller business organizations. And obviously, a large number of these smaller organizations is in the form of partnerships. Now, in response to this concern, it is recognized that in some circumstances, a basis or method of accounting other than GAAP may be appropriate and may not adversely affect the fairness of the financial statements. The Auditing Standards Boards on the American Institute of Certified Public Accountants, the AICPA, recognizes several other comprehensive bases of accounting. Now, these once again are known as the OCBOA, known as the other comprehensive basis of accounting, that are going to be acceptable other than GAAP. Now, these other comprehensive bases of accounting is known as the cash basis of accounting, and modifications of the basis, such as a modified accrual basis, whereas some transactions will be accounted for and the cash basis, and other concepts, maybe such as depreciation or other things, might take on the accrual form. So modified accrual basis or cash basis. Another one is the tax basis of accounting, which is based on taxation principles that are going to be used to file an income tax return. Now, tax basis accounting generally consists of a cash basis format or an accrual basis format, with certain exceptions primarily resulting from tax regulations differing from GAAP. Now, in practice, it is very common to find partnerships using a comprehensive basis of accounting other than that of GAAP. Now, due to the special tax aspects of a partnership, many such entities use the tax basis of accounting rather than GAAP. Partner disassociation. Although a partnership is easily formed and does not need state approval, its life is limited and it may be dissolved much more easily than that of a corporation. A partner may be disassociated from a partnership upon the occurrence of a number of events. In some cases, the disassociation may be voluntary or involuntary. Some examples include a partner's desire to willingly disassociate, death, or becoming a debtor in bankruptcy. Now, a partner's disassociation may or may not result in a dissolution and winding up with a partnership business. For example, a partner may sell their interest in a partnership and therefore become disassociated, even though the dissolution of the partnership does not occur. However, upon the occurrence of certain events, a partnership is dissolved and its business must be wound up. Now, some events that result in the winding up of a partnership include the express will of all the partners, the occurrence of an event agreed to in the partnership agreement, or a judicial determination that it is not practical to carry on the partnership. Now, some of the tax considerations that need to be taken into account for partnerships. Unlike corporations, a partnership is not a separate taxable entity, but a conduit through which taxable income or operating losses pass to the tax returns of the individual partners. The partnership must still file an information return. This return is the Federal Form 1065, which details the partnership's revenues and expenses that ultimately pass through to the individual partners. Now, the tax code does not view a partnership as a separate, distinct entity, but focuses rather on the individual partners. Therefore, activities of the partnership must be evaluated from a tax standpoint based on their impact on individual partners. So, accounting for partnership activities. The activities of a partnership consist of several phases, including the initial contribution of capital to the partnership. This initial phase provides the capital necessary to begin operating activities. Now, contributions and distributions of capital. Now, the capital contributed by shareholders to a corporation is accounted for in several accounts. These accounts include capital stock, paid in capital in excess of par, and retained earnings. Now, unlike a corporation, the capital investment in a partnership generally is accounted for through two accounts for each partner: a temporary account referred to as the drawing account, and a permanent account referred to as the capital account. So two accounts here: the temporary account, which is known as the drawing account, and the permanent account referred to as the capital account. It is not unusual for a partner to withdraw available assets from a partnership throughout the year. Typically, this withdrawal is withdrawing cash from the partnership. In some instances, withdrawals in excess of some amount are considered to be a direct reduction of a partner's capital account rather than a withdrawal. Some partnerships view any withdrawal as a direct reduction of a capital account. However, in some partnerships, a separate account referred to as a drawing account is used to record a partner's withdrawal of capital. Withdrawals of assets, regardless of how accounted for, reduce the overall net capital of individual partners and the partnership as a whole. So now let's talk about the drawing account. The drawing account is a temporary account and is periodically closed to the partner's capital accounts. Now, the balance sheet of a partnership, therefore, will present only the capital account balances of the partners. So to summarize, the drawing account established for each partner is debited and credited for the following transactions. So debits would be periodic withdrawals of a partnership assets up to let's try this again. Debits to the drawing account would be periodic withdrawals of a partnership assets to a specified amount. Credits to the drawing account would be closing of the balance to the partner's capital account. Because remember, these balances, the drawing accounts, are going to be closed at the end of the reporting period or at the end of the year, which will ultimately show the end result of the partner's capital account. Now, each partner's interest in the net assets of the partnership is measured at book value in the capital account and established for that partner. This account indicates the destination of capital upon the dissolution of the partnership, meaning claims to the net assets if the partnership was dissolved. It is important to note that the capital balance does not normally reflect the fair value or tax basis of the partner's interest in the net assets of the partnership. Now, to summarize, the partner's capital account is debited and credited for the following transactions. So here we see the capital account. We have the debits on the left and the credits on the right. So some of the debits that we would expect to see in a capital account would be withdrawals in excess of a specified amount, closing of a net debit balance in the partner's drawing account, partner's share of partnership's losses. Some of the credits we would expect to see in a partnership's capital account is initial and subsequent events or investments of capital and the partner's share of partnership's profits. Now, as is the case with all entities, the investment of capital in a partnership should be initially measured at the fair value of all tangible and intangible assets that are contributed. An individual partner's liabilities that have been assumed by the partnership also should be recorded at fair value. Now, the post-closing balances and the capital accounts of the various partners represent each partner's interest in the net assets of the partnership at a point in time. A partner's interest in the partnership is different from the partner's interest in the profits and losses of the partnership. So the allocation or division of profits and losses. An important process to be outlined in the articles of a partnership is the manner in which profits and losses are to be divided among the partners. There are several alternative methods of allocating profits and losses. However, if the articles of incorporation, or I'm sorry, not incorporation, this is not a corporation we're talking about, it's partnership, so I apologize. However, if the articles of partnership are silent on this point, the RUPA states that the profits and losses are to be divided equally among the partners. The division of partnership income should be based on an analysis of the correlation between the capital and labor committed to the firm by the individual partners and the income that subsequently is generated. As a result, profits might be divided in one or more of the following ways: according to a ratio, according to the capital investments of the partners, and according to the labor or service rendered by the partners. Now we'll start off with the ratio percentage. So profit and loss ratios. Now, partnership agreements frequently call for the allocation or division of profits and losses according to some ratio. Normally, the ratio set forth the division of profits is also used for the division of losses unless a specific provision to the contrary exists. This method obviously provides a simplified way of dividing profits and, if approached properly, may provide an equitable division as well. Now, theoretically, the ratio should attempt to combine into one base the capital and service contributions made by the respective partners. Again, it is important to note that a partner's interest in profits and losses is often different from the partner's interest in total partnership capital, meaning the partner's interest in total net assets is what we're talking about there with total capital of the partnership. Next, we're going to talk about capital investment of partners. The capital investments of the partners, represented by the balances in their respective capital accounts, may be employed as a basis for dividing a portion of the profits. The division is accomplished by imputing interest on the invested capital at some specified rate. This interest is not viewed as a partnership expense, but rather as a means of allocating profits and losses among the partners. Now, typically, the balance of profits not allocated on the basis of the invested capital is going to be allocated according to some profit or loss ratio. Now, when the partner's capital investments are to be used as the basis for allocating profits, the partnership agreement should specify the following. The first thing that should be specified is whether the respective partners' capital balances are to be determined before or after their partners' year-to-date withdrawals recorded in their drawing accounts are offset against their capital accounts. The second is whether the amount of capital investment for allocation purposes is to be capital at the beginning of the accounting period, capital at the end of the accounting period, or weighted average capital during the accounting period. And the third thing here that's of concern is the rate of interest to be imputed on the invested capital. Now, it is important that the partnership agreement clearly establish how invested capital is to be determined. Since each partner's equity is really a combination of capital and a drawing account balances, partners' drawings may be offset against the balances in their respective capital accounts for purposes of allocating income based on invested capital. Now, lastly, we'll talk about the labor or service rendered by the partners. Now, a partner's labor or service to the partnership may be a primary force in the generation of revenue. Normally, the profit and loss agreement recognizes variations in effort by calling for a portion of income to be allocated to the partners as a salary. Such salaries, like interest on capital investments, are viewed as a means of allocating income rather than as an expense. Now, it's important to note that this treatment of partner salaries differs from the treatment of employee/shareholder salaries in a corporation. And the difference should be considered when the performance of a partnership is being compared with that of a competing corporation. Now, when dealing with a profit and loss agreement that employs salaries as a means of allocating income, it is important not to confuse such salaries with partners' drawings. Generally, a partner's drawing is not viewed as a salary, but as a withdrawal of assets that reduces the partner's equity. Bonuses to partners also may be used as a means of recognizing a partner's service to the partnership. Such bonuses are most often stated as a percentage of partnership income, either before or after certain other components of the allocation process. Bonuses may be stated in reference to a variety of variables such as sales, gross profit, or a particular component of net income. So let's look at this basic schedule for allocating profits. And this is assuming multiple bases of allocation. In many cases, income is allocated to the respective partners by combining several allocation techniques. To illustrate, assume a profit and loss agreement of ABC partnership contains the following provisions. Interest of 6% is to be allocated on that portion of a partner's ending capital balance in excess of $100,000. Partner C is to be allocated a bonus equal to 10% of the partnership income after the bonus. Salaries of $13,000 and $12,000 are to be allocated to partners A and C respectively. The balance of income is to be allocated in the ratio of 2 to 1 to 1 to A, B, and C respectively. Notice that these provisions govern the allocation of profit and not the actual distribution of assets. Now, assuming a partnership income of $33,000 and an ending capital balances of $80,000, $150,000, and $110,000 for partners A, B, and C respectively, income is allocated to the partners as shown in this illustration here. So once again, we have partners A, B, and C, and then the total amount. So the first thing is the interest on capital. We know interest of 6% on ending capital in excess of $100,000. So we already know, we said that, so interest of 6% is allocated. Let me get off this thing. There we go. Sorry. Interest of 6% is to be allocated on that portion of a partner's ending capital balance is in excess of $100,000. So we already know that partners B and C are going to be the ones who benefit from this because partner B has a capital balance of $150,000 and partner C has a capital balance of $110,000. Partner A does not benefit because it's only in excess of $100,000 and his capital balance is only $80,000. That's why he's being left out here. So relatively, allocating that the 6% on the ending capital in excess of $100,000, partner B will receive $3,000 and partner C will receive $600. And once again, interest of 6% on the portion of a partner's ending capital balance in excess of $100,000. So that means for partner B, it's going to be based upon $50,000, and for partner C, based upon $10,000 because that's the difference over $100,000. Next, the next line, we can see the bonus here. Partner C is to be allocated a bonus equal to 10% of a partnership income after the bonus. So that's why A and B, partners A and B are being left out here, is because it's only applicable to partner C receiving the bonus. $3,000. How we get this $3,000 amount is going to be 10% of multiplied by net income minus less the bonus. We know 10% times 33,000 is going to give us 3,300, and 3,300 divided by 1.10 is going to give us a bonus of $3,000. So that's why partner C receives a $3,000 bonus right here. Now, obviously, it says the salaries, which is the next line, of $13,000 and $12,000 are to be allocated to partners A and C respectively. So we can see here so $13,000 to A, $12,000 to C respectively, total $25,000. Subtotal, we just go through and sum them up. We can see 13,3, 15,6, and 31,6. So as we can see, there is still a remaining profit that has to be allocated. And it's going to be allocated in a ratio of 2 to 1 to 1 to A, B, and C respectively. So we can see here, right here, the subtotal of 31.6, so we still have 1,400 left over. On the ratio of 2 to 1 to 1, based upon this 1,400, do the math and break it down. A receives two shares, so half of that in essence. So 2 to 1 to 1, half of 1,400 is 700. So partner A receives the remaining profit of 700. And partners B and C each receive $350, which is obviously 25% of 1,400s on the basis of 1 and 1. So that is how we break down the remaining profit. And then once again, we just add them up again, the subtotal with the remaining profit for each of the relative partners, A, B, and C, and it'll give us the profit allocation between the three partners, and ultimately the total of $33,000. So that's the basic schedule for allocating the profits.
and using multiple bases of allocation, meaning based upon interest, the bonus, and salaries, and that other remaining profit. Excuse me. So the allocation of profit deficiencies and losses. If the income is not sufficient or an operating loss exists, one of the two following alternatives may be employed, assuming that the agreement governs both the allocation of profits or losses. Now, the first one would be completely satisfy all provisions of the profit and loss agreement and use the profit and loss ratios to absorb any deficiency or additional loss caused by such action. The second option would be to satisfy each of the provisions to whatever extent possible. So to illustrate these alternatives, assume the same information that was just used in the previous example for the ABC partnership, except now that the partnership income is only $22,000 as opposed to $33,000. The income of $22,000 is divided by using the first alternative. It is important to note that the allocation of interest, bonus, and salaries results in an excess allocation or deficiency of $8,600, which is a subtotal of $30,600 less the income of $22,000, which must be subtracted from the partner's previously allocated amounts. So what that means is, in this previous slide here, how the profit right here of the $31,600 was previously allocated out. We went ahead and went through with this. Obviously, the bonus deferred because it was based upon $2,200 and not the 33 or 22,000, not 33,000. So this differs. These are the same. So we went about it that way, allocating as it should be. And obviously, there's a deficiency because we've allocated $8,600 too much. So this deficiency is going to be allocated among the partners according to their profit and loss ratios, just like a remaining profit, except that the deficiency is subtracted rather than added. So the same thing here. So as you can see here, here's the deficiency. Up here is the same step for partners A, B, and C as we did in the previous example up here on slide 9. Only difference is that of the bonus for partner C because it's based upon a different net income. So we can see here there's a deficiency instead of the remaining profit. So it's fairly straightforward. Same concept, just inversely stated here. So we have to allocate this deficiency of $8,600 amongst the partners on the 2-to-1-to-1 ratio. So therefore, partner A would be subtracted a deficiency of $4,300, and B and C $2,150 relatively to each partner because it's on the 2-to-1-to-1 basis. Because half of $8,600 is $4,300, and a fourth of it is $2,150, making up a total of $8,600. Once again, instead of adding the remaining profit to get the profit allocation, we're simply subtracting the deficiency. Same thing here. Now let's take one more example, deficiency allocated by priority. So the second alternative, which is used less frequently, requires that the provisions of the profit and loss agreement be ranked by order of priority. Now, assuming the components listed in the previous illustrations are already in order of priority, a partnership income of $22,000 would be distributed as follows. So interest on capital, once again, 6.3. The bonus here, because it's a $22,000 bonus to him, same as it was on the other one. The 10% of the net income after the bonus has been given. And the salaries here, 16.4, to whatever extent possible. 16.4. So we're gonna allocate these amongst these partners right here. So the salaries of 16.4 would be allocated to partners A and C according to the ratio suggested by their normal salaries of 13,000 and 12,000 respectively. So that's why we're stopping right here. Whereas the other slides, we kept on going with other examples. We had a deficiency or a remaining profit. Well, that's not the case because we know that we are going to go just to go as far as we can based by priority. So we know the priority of the income has to go to salaries of 13,000 to A and 12,000 to C. So that's why we're just going as far as we can. So B in this case, other than the interest on the capital, is going to be left out. They're not receiving any bonus and they're not getting any salary because A and C has priorities to that salary. So in order to find that, A would receive 13 divided by 25 multiplied by 16.4, which would give us the 8,528, or while C would receive 12 divided by 25, or $7,872. And once again, you sum the columns up just as before, and that's the total allocation of the profit when the deficiency is allocated by priority. This wraps up chapter 13 and dealing with partnerships, characteristics, formation, and accounting for activities. As always, if anyone has any questions or concerns, feel free to shoot me an email. You can call my office phone. The number's listed on the syllabus. And also my office hours are Monday, Wednesday, Friday, 9 to 12 in Mahood. Office is room 211. So as always, I'm always available to any students who are struggling or having questions with the content being covered. Once again, remember the homework for chapter 13 is going to be understanding the issues, number 1 and 3, and exercise 3. Once again, this homework will be due next Monday at 11:55 p.m. I will post the solutions prior to the when it is due so that you can have a checkpoint and get credit for your homework assignment. And once again, please try it on your own before looking at the solutions. So these are just merely so you can get the credit for it and check your work. So please try it prior to receiving the solutions. And once again, I will have exam 2 grades posted by no later than tomorrow and hopefully by noon. So once again, this wraps up chapter 13. And next week we'll be getting into chapter 14. So that is all. I hope everyone has a good day, and I will see everyone next week.